From the City of London for our audience worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, the global economy grappling with a second wave.
We're now, deep into the second wave of the pandemic.
A resurgence of cases.
New cases rising again.
Reinstatements of some kind of local restrictions and lockdowns.
This will continue to downplay any kind of recovery.
We are talking about localized restrictions.
We have to temper down the expectation of its impact on the economy.
They're not shutting down activity completely.
I don't think a return to full lockdown is that likely.
This economic recovery, again, is becoming choppy.
We are in a recovery from one of the deepest recessions in history.
It's becoming uneven.
That recovery is going to be quite strong next year.
The V-shaped recovery path looks very much secure.
It's likely that the U.S. economy struggles to crawl back.
We're sort of seeing this two-speed economy develop.
George Bory of Wells Fargo Asset Management joining us now. George, always fantastic to catch up with you, sir. It is different this time. That is true. How different is it, George?
Yeah, well, thanks, John. It's great to be on the show. It is different this time. And I think, as many of the people you just highlighted mentioned, there are sort of varying degrees of factors that the economy, both the domestic U.S. economy and the global economy, are facing. And COVID is absolutely at the top of the list, a resurgence of cases and the economic impact that is starting to have on both individuals, companies, and governments around the world is becoming increasingly clear. And as we, at least in the northern hemisphere, go into the winter season, then the expectation is that cases will continue to rise. But, that being said, as you also heard, specifically here in the U.S., the U.S. economy is still very much in recovery mode. The recovery is uneven. It does seem to be decelerating, but that being said, it is recovering, and I think that is the one point that we like to reiterate when we talk to clients and when we talk amongst ourselves and the investment teams, is that the economy is recovering. The stimulus from earlier this year, both fiscal and monetary, continues to help the economy today. And individuals and corporations have adjusted to what we would call, the COVID economy. We don't see that going away. I mean, if you look back 6 months...
So that is the question at the moment, George. How much faith you should have in this recovery and how you should push that through this market. Now, I know recently that you took off the steepener in the Treasury market. If you believe the recovery continues, what's the trade through Treasuries?
Right. No, we do think the recovery continues. But, what we've been saying, if you look back 6 months ago, this economy was really like circling the drain for the most part. But since then, it's kind of come back. It came back very strong in the third quarter. We think that expansion continues into the fourth quarter. Now, with respect to yields, we think over time, bond yields will continue to notch higher, but it's going to be a very intermittent trade. And we saw the long end sell off earlier this month. We saw a nice steepener, 530s, that had been in place for the last several weeks, last few months. And we decided to take some profits on that. Since then, bond yields have come down. And if you look at the long end, we are starting to find new trading ranges, both in 10s and 30s, and even further in along the curve. And that's really our expectation. Right now, we've got two big challenges. One, COVID. The other is the election. The election hopefully will be over in a couple of weeks, but to the extent that it sort of drags out, then obviously there will be a deep bid for Treasuries on the back of that. But COVID really is the dominating fundamental force that's ultimately going to drive the direction of yields.
So you mentioned three things there: COVID, the election, and the new trading range. Let's deal with the latter two. We've talked about COVID a little bit. The new range, right now on a 10-year, 0.736% on a 10-year. We know the lows post-April, 50 basis points. We know the highs first week of June, 90 basis points. So we're slap bang in the middle of that range. What range are you talking about, first of all, George, for 10-year Treasuries? What's the new range you're looking at?
So I think we're very close to what is probably the low end to the middle of that range. Our expectation is the ranges are going to remain relatively tight. So if you think sort of a 70 to 80 basis point range is a good estimate, at least between now and into the election remaining. Once the election is complete, then I think we could see a little bit of a breakout once there's some clarity. But going up to that point, we'd expect a pretty tight range. Now, going forward, because of COVID and that being a material overhang on markets, absent a vaccine, the expectation is that bond yields are going to remain pretty well contained. The Fed is not taking its foot off the accelerator. They're not pulling back their support for the market. They're going to remain heavily involved in both, the Treasury market, the mortgage market, and sort of capital markets more broadly. That will keep yields sort of somewhat contained. If we were to see kind of a sharp acceleration, a sudden, the emergence of a legitimate vaccine that could be rolled out quickly, and some clarity, irrespective of which way the election goes, but just some simple clarity that the election worked, it was clear, it was decisive, and that the people that won are now in charge, that would lift a lot of uncertainty off of the market. You could see bond yields rise at that point. But a lot of, that's clearly a lot of factors, and we need to wait to see where those factors ultimately kind of resolve themselves.
One thing you haven't mentioned, George, and obviously we need to wait until November 4th, but let's just explore some of the scenarios. People in the equity market have been talking a lot about pricing in a blue wave. Yet at the same time, they're discussing $2-3 trillion fiscal stimulus plans. I'm staring at a Treasury market that's hardly adjusting. And a question I visited periodically over the last several months is whether supply does actually matter at the long end of the curve. Do you think it does, George?
Supply matters, I'd say, up to a point. The U.S. government, is going to be issuing a tremendous amount of debt over the coming months, quarters, and even years. The demand for treasuries remains pretty robust, but you can get saturation. The reality is that with yields remaining pretty low, liabilities remain pretty large, and there actually is, believe it or not, there actually is a shortage of high quality duration in the world to basically, immunize liabilities that insurance companies hold, that pensions hold, and that other kind of long-term investors hold. So we're not overly concerned about supply, but in short waves and in heavy doses, it can overwhelm and saturate the market. I think going into the year end, we're not overly concerned about sort of oversupply. As we get into 2021, we could start to see concerns of more supply. And then, as you mentioned, to the extent if we were to get another significant spending package, stimulus package, then clearly, that could start to put a little bit of pressure on the market. But as of now, we are not overly concerned about oversupply.
Well, let's talk about supply elsewhere in the credit market, not just investment grade, but junk as well. This quote from Bank of America: current spreads barely compensate investors for the inherent credit risk, which is outside of the scope of the Federal Reserve. High yield spreads right now, 475. George, what do you think when you hear that line there? That we're not adequately compensated right now for default risk in high yield?
I don't agree with that, actually. I think default rates are high, but default rates are showing signs of coming down. I think the point being that yields are low and that capital markets are open, allows a wide range of investors to basically refinance their existing debt as well as access capital markets. And to the extent a company, just like an individual, can sort of maintain access to funding, that is a support mechanism that keeps a company kind of very, very viable. As you look across high yield spreads are tight. I don't disagree with that, but I do disagree with the notion that you're not being adequately compensated. It depends on where you look. The spreads that they're quoting is an average spread. There are many high quality, good companies that have debt ratings that are below investment grade, that are high yield or junk, however you want to define it. But these are functioning companies. They're not stressed. They're not at risk of going out of business. What they are highly levered. When a highly levered company is able to refinance its existing debt, drive down its cost of borrowing, that materially improves its credit metrics. And we've seen that happen over and over and over again this year. We expect more of that going forward. I'm not trying to downplay the risk. A higher levered company tends to be more sensitive to growth and to economic conditions. But generally speaking, we see that the credit quality within the high yield universe should get better going forward, not worse.
George, just a final question from me on high yield. And for this conversation, we're talking about the secondary market here. Have you noticed the market getting a little bit more selective in the primary market for some of the new issues coming through?
So the new issue market has been pretty robust. We're on another very, very punchy year of issuance, and it slowed down a bit as we come up to the election. We expect once we get through the election, we'll see that tick up. But as you've seen over the last few weeks, or really the last week or so, we have started to see some issuance slow down, and it's mostly because borrowers, if they approach the market and they're not getting the level of rates that they want, they've been willing to to really step back. It hasn't been a question of demand. It's really been about sort of are you getting the right or getting the yield level that the borrower ultimately wants, which basically means if they're not getting ultra low borrowing rates, then they might pull back on the assumption that maybe they could reapproach the market at a future point in time and get better yields. So, supply in the corporate bond market always follows demand. It always does. And we live we live by that premise. We don't see that going away anytime soon. And so you can get little moments and periods of disconnect where there's a little bit too much supply, but that tends to rectify itself very quickly. It tends to iron out. And, for the most part, if demand starts to pull back, you'll start to see a material slowdown in supply. We're seeing a temporary pause. I think it's due to the election. Once we're beyond that, we expect supply to pick right back up.
Hey, George, great to catch up. Hopefully we get to catch up before the election again. George Bory there, weighing in on this fixed income market. Time now for the final spread, the week ahead. Coming up next week, Fed Chair Jay Powell participating in a virtual IMF World Bank meeting on Monday. The Fed's John Williams and Charles Evans speaking on Tuesday. We get the Beige Book on Wednesday. That is the final presidential debate on Thursday, and a slew of preliminary market PMIs on Friday, including figures from the United States, France, Germany, and the Eurozone. From London, that does it from us. We'll see you next Friday at 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg TV.